Let's talk more about what this morning's economic numbers and earnings reports mean for investors and what we should all be doing. Joining us right now is Christopher Ailman, CalSTRS Chief Investment Officer. CalSTRS is, of course, the nation's second largest public pension fund. It now has more than $225 billion in assets under management. Christopher, good morning to you. Thank you for joining us. Just walk through how you're thinking about the markets right now.
Well, Andrew, it's really about taking a look at your asset allocation. I'd encourage all investors to back away. As much as Kramer likes to look at individual stocks, I've got to look at the whole market as a broad portfolio. And we've repositioned ourselves very defensively, underweight equities, overweight fixed income, and risk mitigating assets. And then really trying to take the opportunity to communicate with people. And this is about the time, while the rally this last week really surprised a lot of people, where you have to start also looking at where are opportunities to get back in.
So given you've become defensive, I'm curious, are you looking at this? We keep debating, is this going to be a V? Is it going to be a W? Is it going to be a hockey stick? Let's hope it isn't. How do you see it?
You know, probably more like a square root. I think last night Kramer went through the amount of monetary and fiscal stimulus we've seen, which is huge, unprecedented. So I think you are going to see some strength in the economy in the third quarter, but we've still got to get through the second quarter. And that Empire State number really shows you how dramatically the economy has been shut down. I doubt we stopped the economy almost on a dime, which is amazing, but I don't think we're going to be able to restart it as efficiently. We're going to end up stumbling out of this slowly, but we will rebound on the other side.
In terms of your long-term perspective, you know, there are a lot of investors out there that say, you know, the stock market should be up. Maybe it's reasonable today. Maybe it should even be higher on the thesis, effectively, that if we're going to print money the way we are, assets should be more valuable. Do you buy that?
I am afraid of the amount of money that we are printing. Good grief. At some point, somebody's going to start paying attention to the deficit. And all of these programs, I'm worried the Fed is going too far with some of these programs, buying high-yield bonds, waiving mark-to-market rules. Those things are going to have consequences. I think that we aren't going to get, well, let me say, I don't believe we will get back to the February highs right away at all. I think those were extreme levels. But the market really last week was obviously certainly surprising. Will we go back and retest or touch near those lows? I still believe that we probably should and will eventually, as all this kind of economic news and earnings comes out. You know, stocks don't rise when earnings are getting cut. But this stimulus will have an impact without question. And we should expect that probably the market will come back a bit stronger.
As the leader of a public pension fund, what do you make of the bailouts of the airlines, for example, in terms of what public policy should be?
You know, Andrew, it's such a tough call. And it's almost as if with the amount of bailouts and, as I mentioned before, the Federal Reserve stepping in to different markets and bailing out different industries on a fiscal basis, it's as if we're going to look past a recession and the government's going to take that burden. Long term, that has huge consequences and costs. We saw in 2008 that the Federal Reserve was able to start to reduce its balance sheet, but it took almost a decade. So I think we're going to see the implications of some of these moves, and it's not until we get some perspective of a couple of years where we find out what is the true cost. But yes, there are certainly some actions in here that
Chris,
are possibly concerned.
The reason I ask about this specific question, and I'm not picking on the airlines, but we are in a situation where clearly we have decided that we are going to socialize losses and privatize gains. That has happened. We've now seen it 2 times effectively in the last, call it 12 years, between 2008 now and 2020 with this pandemic. One of the arguments that people make oftentimes about saving the airlines, for example, is both their critical nature, but the question is are the shareholders of these airlines somehow special or critical? And they say, well, you got to save the whole company because pensioners are shareholders too, and we need to save them. What do you think of that?
Yeah, I have to say I don't buy into just the pensioners. Yes, they're important, but they're a small percentage. I think we have to start saving individual people. But it's a question of overall costs. And as you said, that all of a sudden, too big to fail. Remember that term from '08? Now we're implying that almost everything is too big to fail. And I hate to say it, but in capitalism, we should have some destruction, even from events that people can't foresee. It's just different with this being a health crisis. I think there's the view in Washington that they can bridge this with government money, but somebody's got to pay that government money back. So I am concerned about this. I don't buy into the argument that it's about saving the pensioners. I think it's about saving the overall economy. And right now that starts with this jobless claim number of, 6 million last week. What's it going to be tomorrow? Those are huge losses of individual people. They're the ones that need the support during this time period.
And then the sort of follow-on question becomes, how are you going to allocate your capital? Do you look at this environment and say, I need to put more money to work, for example, in private equity, because they're going to start to try to buy up things potentially that may be opportunistic over the next year? I want to be more an active rather than passive.
Andrew, it won't surprise you that the private equity firms have already started raising dislocation funds. I think investors are going to take a look at those, but with a skeptical eye. This is not a financial crisis. And as we were just discussing, the Federal Reserve and Congress are going to soften the blow to the financial side. This is a health crisis. So there are going to be investment opportunities, obviously, in certain industries. But they're not going to be the strong returns that people saw in '09 or 2010. But yes, I think as a long-term investor, we're counter-cyclical. So when things are down, the pension industry will be coming back in to buy. Most of my peers and ourselves included had a lot better position in cash coming into this. So it gives us an opportunity to slowly start to turn on offense and look for opportunities to invest.
Christopher, final question. For so very long, even just 2 months ago, all we talked about was ESG. It's something that you've talked about as well, and the CalSTRS has been behind. The question is ESG, is this the beginning of ESG or the end of ESG, especially in an environment where clearly if you had great governance, if you had prepared for the worst, that moral hazard is almost over because the government's going to come protect everybody who didn't.
It gets me riled up, I got to tell you. ESG absolutely still matters. I understand that challenge of if you have bad governance, the government is bailing you out. That's part of the problem with the government stepping in and creating a safety net under Wall Street. But no, ESG absolutely does matter. The environment, the climate still matters. Governance is showing, and we're going to see that in these quarterly earnings reports coming out this week and next and after that, of companies that are better governed, better prepared, think about those long-term risks versus companies that just put all the risk into each individual quarter. So ESG is going to matter, and I think you're going to hear about it more, not less, coming up.